Good morning and welcome to the third session on Chapter 8, National Income Accounting. In this session, we are going to see about the concept of measuring the GDP using the income method and the various types of prices like factor price, the basic price, the market price, and the different concepts in terms of the accounting. Now, this is a very important chapter. Why? Because we are going to understand and analyze a very important method called as the income method for measuring the income in terms of the gross domestic product. So, moving forward, these are the topics: the income method, the calculation for income method, factor price, basic prices, market price, gross national product, and the GNP calculation. So GNP is also going to be a very important topic when it comes to national income accounting, and it does form a very important part of the Indian economy. So moving forward, income method. Moment the word income comes into picture in economics, everybody is interested. Why? Because this is actually what we consider it as a receivable. So I always use the word called as a receivable. That is very important for us to understand. It is receivable. Income comes to you. You do not go in search of money. Now money is coming in search of you. So the receivable factor. So how do you calculate the GDP by income method? GDP by income method is equal to sum of total factor incomes, which is equal to the total wages received. Which means to say that if you are working today in an organization, company, institution, you are receiving some money in the form of wages or in the form of salary. So the factor income that you are receiving is equal to the total wages received. So which means to say that the money that is received by the employee is equal to the factor income. So this income method will judge the people, will judge the economy by the amount received. Here we are not going to talk about payments. Here we are going to talk about the income factor. So the amount received in the form of wages is equal to the total factor income. That's how we are going to calculate the GDP by income method. Now, if you look into countries like China, Finland, Norway, Sweden, Switzerland, or probably even most advanced countries like Hong Kong and Singapore, they are those kind of economies where the people are highly paid. Why are they highly paid? It is not just because of the cost of living. It is because the service output, what they are producing and they are exporting, comes at a cost. They sell their product or service at a higher cost. So the people working in that country receive higher incomes because of the factor prices and the system that is available. So automatically the income that is being received by a person living in those countries will be equal to the factor income that is given by the government. So those are a very important concept in terms of understanding the GDP by income method. Now in India, we have a standardized labor or a wage rate system through which we pay each and every individual based on the work, based on the skill, and based on the type of work that he is going to do. So in that sector, what happens now is that the sum total of factor income, that means whatever money that the government is going to receive because of the service, because of the factor that is being done, is equal to the total wages received. So the total amount that is being given to the employee, that's the equal amount that government is going to take out or the government is going to receive because of the production factor there. So this is very important for us to understand in the economy in the long run, that the quality of income, the levels of income, the levels of payment does matter a lot when it comes to understanding the GDP. So highly paid countries really matter because the GDP is also at a higher rate. The production is also at a higher rate. The services that they produce comes also at a higher cost factor. Moving forward, calculation of the income method. So what are all the factors? We go back with the same equation, C plus I plus G plus X minus M. Now what does C stands for? Consumption. I stands for investment. G stands for government. X stands for exports. Minus M. M stands for imports. So consumption plus investment plus government plus exports minus imports will be equal to income plus the revenue that is all being earned. So the calculation is as simple as this, that we are going to take into account the wages, the prices, the income plus the revenue that is being received. So we are going to see here that the calculation method here is only replaced by income and wages factor. It is almost the same. What we are trying to understand at the end of the day is that the total factor income is equal to the wages that is received, and that's what we are trying to prove here mathematically. The GDP calculation is not changing drastically. What is changing is the factors, the modules, the methods that we are bringing in. But at the end of the day, the calculation remains the same, which means the result will remain the same. It will not drastically change. Now, the next factor that we are going to see here is the factor cost and the basic price. Now, what is a factor cost? Factor cost is the cost of an item of goods or services in terms of the various factors which have played a part in its production, availability, exclusive of tax and cost. Now, factor cost is the cost of an item of the goods or services in terms of various factors which have played. Now, these are the words that we need to pay attention here. For example, you are going to manufacture a car. Now, when you are going to manufacture a car, there are a lot of factor costs that will be involved in the manufacturing. What are those factors? Now, that might be in terms of raw material, in terms of labor, in terms of capital, in terms of the land. So, there are a lot of factor cost and prices that will start coming inside while manufacturing a particular good. Now, those factors have played a price, or they have played a part in the production, which means, now for example, you are using automation technology, you have used robotics, you have used artificial intelligence, you have used some kind of technology through which your production is enabled, is enhanced. Automatically, that is a factor cost for me. That is the reason, if I have to give you a simple example today, if you look into the market, especially if you start looking into MG Hector, I just want to share this example with you. MG Hector, which is landed up in India, is a technologically advanced car. The moment if you look into the logo, you will start seeing internet inside, which is written on the car. Now, what does that tell to you? Now, nobody wants to move the car using internet, but what they have done is that they have projected the image very clearly to the consumer, saying that it's a technologically enabled vehicle. So you don't have to worry about technology. It doesn't come as a separate part, but it's an integrated part of the car itself. Now, that is a factor cost, because technology was something that was explicit until now. But moment Hector came into play, that became a part of the system itself. So all those factors, all those extra features which are being used in the production of a car, in the production of a particular order, or the services that are being imbibed, are all called as the factor cost for us. So tomorrow, when we are coming up with any advanced module of a car, of an FMCG product, of a white goods, whatever is that comes with a factor cost. And those factors can be from any part of the world. So automatically, when factor cost starts going up, the price of the good will also start going up. So that is why it is very, very important. What are all the factors that are involved in terms of manufacturing a good? Technically advanced, automatically there will be a huge factor cost and there will be a price that will also going up. Similarly, now we are coming down to the next factor called as basic price. It is the amount receivable by the producer, very, very important, from the purchaser for a unit of the product minus any tax and plus any subsidiary on the product that has been given. Now, in both of these cases, it is very, very important that the tax factor is not included, because we are not talking about taxation here. We are only going to talk about the basic price. Now, what is happening is, if the basic price of a product is 10 rupees, that is the amount that is going to be received by the producer. Now, Colgate is manufacturing a toothpaste and it is selling it to a consumer at the rate of 10 rupees. So, when he is selling the toothpaste at 10 rupees, that is what Colgate will get from the consumer. Now, is that 10 rupees a part of the tax? Is it added up? GST is put for it? Definitely not. It is only the basic price. So that is why we say that it is the receivable by the producer from the purchaser for a unit of the product minus any tax. So this word is very, very important. Minus any tax. We are not including any tax. Now, if I include the tax, it might be 12 rupees 50 paise or 13 rupees. But I am not including the tax part. Plus any subsidy on the product. Suppose if there is a subsidy given by the government, that needs to be added up. So that is why we say that basic price is the price that is available to the consumer, and that is the price that is going to be the amount that is going to be received by the producer. So that is very, very important for us to understand here. For the manufacturer, it is that basic amount that is going to be got from the purchaser. So these are the two factors that we need to understand. One is the factor cost, the other one is the basic price. Factor cost is again very, very important for us. Again, I am trying to repeat on that factor. Why? Because exclusive of tax cost, it is exclusive. Whichever technology, whatever factors you are bringing in, design, or you are going to bring some innovative factors, or you are going to put in some sound system, you are going to bring in some better visual reality to it. All these factors are a part of the innovation that can make the product look better, that can make the appeal better. But then they are devoid of tax. They are not included in any of the tax. So at any point, when even in the exam stand, we need to understand that factor cost and basic price, both of them are minus tax. They are not, tax is not included at any point of time. Moving forward, market price. Market price is the current price in which an asset is being sold or bought. Now this is a simple factor and this needs to be understood very clearly. Now, I want to go and buy a car. Let's say that I want to buy the new Hyundai Creta 2020, which has been launched this year. Now, the price which has been put in the newspaper, they might say that the Creta starts at 15,99,000 rupees. But when I go to the showroom, I find out that the real price of that car would have been somewhere quite close to 17.5 lakhs or 18 lakhs 32,000 some value. Now, where is that price coming from? That is the market price. Market price means the current price. That is the price that is selling right now in the market. You want to buy the Hyundai Creta, that means you will have to pay the current price, what is being selling in the market today. That is the price at which the store will sell it to you. The salesman will sell it to you. So that is what we call it as the current price at which an asset is being bought or sold. Now, similarly, when we start talking about selling, if I want to sell my Hyundai Creta, I would be selling at today's market price, whatever is the valuation. So for a buyer, the price that is available for him or for her on the market at that time, on that particular moment, is the market price. This cannot be changed as and when you want. It is a trading price. It is a trending one. So you have to go with the market at any given point of time. Now, The economist theory contends that market price converges at a point where supply and demand meet. This we have seen in our previous chapters itself, where we have always spoken about supply and demand. So going back to that graph, you will try to understand if this is the demand curve, which I name it as D, and this is the supply curve, which I'm going to say it as S. This is the place where you see that there is an equilibrium point, this particular point. This is where I'm going to mention it as E. This is the point at which the supply and demand are matching. So that is the market price. Suppose I want to sell my car at 25 lakhs, but the market demand is only 20 lakhs. So that's where the supply and demand are matching. So 20 lakhs would be the point at which the market is accepting the price, and that is what I can sell my car at. So this is what we call it as market price altogether. Moving forward, gross national product. This is another new and an interesting concept that you need to understand from the economy standpoint. Till now, we have always been speaking about what is gross domestic product, but today we are going to speak about gross national product altogether. Now, the gross national product, sir, what is so different about it? What is so new about it? The new factor about it is that it's the total value of goods and services produced and provided by a country in 1 year equal to gross domestic plus the net factor income from foreign investment. That is a very, very interesting part for us. India being an emerging country, we are producing different types of products and services. We are now becoming a global country trying to address the needs and wants of every single country in this world. So now for India, it becomes a challenge to maintain the level of quality, to maintain the level of service and keep on moving forward. So now what happens is that every time when we try to produce something, when we try to give some sort of service to another nation, we will try to understand the value behind it. Plus, we will also start seeing that what is the FII, that is the foreign institutional investors coming into India. What is the foreign investment that is coming? Because if you see the net income from foreign investment, now let's say that there are multinational companies who want to come and set up their offices in India, they will not be setting it for a free of cost. There will be some income that is coming for them because of the production. Because of their production, because of their revenue generation, India will also get a part of the income because we have given them the space to manufacture and provide service. So there is some net income coming because from the foreign investments also. So we have invested, they have also invested their time, money, energy with us. So there is a reciprocal income coming for us. So that is a very, very important. That is called as the gross national product, which includes every part of your GDP plus the foreign investment. So that is where you will be able to see the extra income that is flowing into the country altogether. Now moving forward, how is the GNP calculation? GDP, that is already taken into factor. So the first thing for GNP is that we have already taken GDP as the base plus factor income earned by domestic factors of production employed minus factor income earned by the factors of production of the rest of the world employed in domestic economy. This looks little bit confusing. So in order to make it simplified, that's why I have written, in short, GNP is equal to GDP plus net factor income from abroad. So whatever money that is earned from abroad through investment, through any kind of production, services, offshore entities, delivery organization, all those income, when they pour back into the Indian economy, we call it as GNP. That is why this GNP matters a lot. Now, you might now ask me, why is immigration so important for India? So whenever there is a news in the market saying that US cancels the visa or US rechanges the visa decision, US does not allow people at this particular age, or US is trying to block visas, they matter a lot because from the GNP standpoint, any country for that matter, not only America, be UK, be Switzerland, be France, be any other country in the world, moment there is a blockage for us in terms of immigrating out of those countries or getting income out of the country, GNP will get affected. So that is why income from abroad is very, very important for us, because when we go there, when we start working, and when that income starts coming back into the country, the GNP will start going up. Now, India is one of the largest in terms of the GNP factor, because we have hundreds and thousands of Indians working abroad. And all of them do contribute back to the nation, and that is one of the primary key factors for our gross national product to go up. Similarly, India has also invested in many of the foreign companies, and we do make some income from these companies. So GNP is a matter of high importance when it comes to national income accounting. Moving forward, with this, we come to the conclusion of today's session. I hope and believe that the session was interesting, educative, and informative. In the next session, we shall be seeing about the determinants of GDP, GDP as a welfare, GDP as a benefit for the nation. Until then, thank you and goodbye, and I hope that you will continue to learn and stay enlightened forever. Thank you once again for joining me on this session.